the question today: are we in an AI bubble?
See. All right, get on with it.
All right, everybody, welcome back to our latest edition of Bugle Notes, where we sound off on the topics and the concerns of our clients and a lot of the investing public out there. So I am Stephen Weitzel, joined today by my partners Chad Smith and Michael Benicelli. Thank you both for being here today. So our discussion today is going to be the first of two parts. So today we're going to be talking about, are we in the largest bubble for U.S. stocks that we have ever seen? And we're going to discuss maybe why we are, potentially why we're not. And then our second version of this is going to dovetail into a review of Andrew Ross Sorkin's new book, 1929, where he documents about one of the greatest stock market crashes in U.S. history that is still referenced today and is still alive and well in the minds of many of the investing public, even though we are very far removed from that event. But I want us to begin with this idea, and we've been talking about it in a lot of our monthly reviews and some of the videos that we've done, that we have been in a narrow market, a somewhat narrow market, as defined by the fact that there have been a very small percentage of stocks within the S&P 500 index that have actually been outperforming the S&P 500 index. Yeah. So the largest 10 stocks within the S&P 500 index now account for close to 40% of the entire weighting, which is an all-time high. It's materially higher than what we saw at the peak of the dot-com bubble. And so we've talked some about in the past the perils of indexing and how on the other side of a bubble, you are more exposed to areas that have higher valuations and are more susceptible to downside. And so kind of the reckless nature of passive index investing that has really taken hold of a lot of our industry and the way that a lot of clients are positioning today. But with that as the backdrop, let's ask the question, are we in a bubble right now? Are we in an AI-driven bubble? What are some of the markers that we're looking at that we're concerned about? What do investors need to do to protect themselves from this? So let's start with Chad. Are we in a bubble, yes or no?
I think yes. It's becoming a growing consensus, of course, in the market that we are. So we're not really in the minority anymore. We were kind of that way for a while, not per se betting against it, but just trying to recognize it, and then be conscientious of where we are in the annals of market history and cycles that exist. But by multiple measures and accounts, we are absolutely in a bubble. The question is, obviously what we're going to try to answer is, what does that look like?
How big does the bubble become before it bursts?
Correct.
Okay. Michael, are we in a bubble, yes or no?
I'd say it's a yes from me also. And it probably makes sense for us to spend a little time trying to define what we mean when we say a bubble, because there's, markets get overvalued. It happens, right? We see narrowness in the market. It happens a lot. But we really need to define what makes this a little bit different than those types of markets. So, there's a lot of, I've been reading up on a lot of market commentators, PMs, hedge fund managers that, the guys who have been in the business for a long time that have seen these things happen and have their own take on it. And so I think we're going to mention a lot of names as we go through this of folks that we read about and read their commentary. But I think we got to spend a little time defining what it really means. I think one of my favorites is Howard Marks in particular, runs, Oak Tree Capital. And he always defines it as it's a feeling, it's a state of mind, it's the collective mentality of the market, not necessarily quantitative, right? There's a lot of quantitative factors that go into it, but I always liked his perspective on it because it was this idea of irrational exuberance, the belief that you're investing in things that possibly can't or couldn't possibly miss depending on how much money you put into them. There's no price too high, all these different things that are not quantitative, they're qualitative factors. So from my perspective, yes. But.
So I just want to say that for all of these, and we're all kind of in agreement here, that we do believe that we are in the midst of a bubble, whether it turns out to be one of the largest bubbles that we've seen in history remains to be determined. But bubbles have a way of, they move around, right? So just in the last 25 years or so we had the internet bubble that built through the late 90s and peaked right around 2000. We had the housing bubble, and then I would say we had a bubble in energy in kind of the mid 2010s that really culminated during COVID in 2020. So those are kind of three of the more recent bubbles that we've had. Chad, you made a comment about how the number of people who are now seemingly concerned about the prospect that we're in a bubble or valuation is growing in number some.
And I find that really interesting too, because number one, you never know whether you're in a bubble because by definition it has to pop for it to be a bubble, right? And number two, you ask the question of, are you really in a bubble if everybody thinks it is one, right?
Well, I would say we could play the clip from The Big Short when Christian Bale, as Michael Burry's character, says, "There are always markers." And but I remember going back these are the early days of my career, but leading up to the financial crisis, which that housing bubble, real estate bubble that spilled over into the banks, that took the banking index down 80%, number of banks that went out of business. You still have companies like Fannie Mae and Freddie Mac that are under government conservatorship. That there were plenty of people in 2006, or so, even earlier than that were saying we have a housing bubble going on.
I was one of them.
Right, and
I was on record writing that we were.
But the bubble didn't seem to burst right until kind of 2007, and it really didn't materialize in the market until 2008, which is when a lot of the scars actually showed up in the stock market. So, but I want us to bring it back to current times. Let's talk about how that if we're in a bubble today, that it is likely highly related to the AI space. So we're kind of back in the technology path, as this is going to be the source of malinvestment. And that's one of the terms that I feel like we want to highlight today.
Yeah.
That a bubble, as I will describe, is differently from just an overvaluation that's in the pocket of a certain area of the market where the stock market can come down meaningfully. But to me, what separates a bubble from just kind of a mania, that let's say we had a mania in meme stocks. There you go. Was GameStop was one of them so that was a mania,
right? And
those things crashed.
Right. It was confined to the stock market, so it was more of a financial versus an economic or technological boom or bubble, and it resulted in investment capital, meaning just investors chasing after buying stocks that ran up and then quickly came back down. But it didn't translate into capital allocation like at the industry level. It was altered.
Yeah, and I would say that the big difference there is that people who invest money in stocks, maybe they don't all recognize this, but they can lose money, right? They can lose.
You don't say.
They can lose meaningful amounts of money. But what is different in bubbles is that you have people that don't expect to lose money, bondholders that get wiped out. That is where the malinvestment happens. So I want us to talk about it as it relates to this AI capital expenditure that we're seeing right now. So as we were talking and preparing for this, Chad, you had mentioned something about how a lot of these businesses, whether it's the Microsofts of the world, Google, Meta, OpenAI, which is the new company behind ChatGPT, that these companies were historically asset-light businesses, but now they're having to invest hundreds and hundreds of billions of dollars to build out these data centers. And oh, by the way, because they happen to be the largest components of the U.S. stock indices, so go the direction of these stocks largely is going to determine the direction of the U.S. stock market at large.
Exactly. And so if you look at what has helped to drive these companies, the Mag 7 as an example, over the last several years, let's say 10 years, they have, in fact, produced significant revenue growth, very impressive net profit margins, very impressive free cash flow.
Which was different from what we saw maybe in the late 90s with the internet bubble.
Absolutely. So in that regard, many of these companies that are historically now at a point where they are relatively overvalued versus the rest of the market, versus their own historical averages, et cetera. But you could argue that was somewhat justifiable because they were leading the charge in terms of, as a percentage of the S&P, making up a large chunk of the revenue and profit and cash flow generation. But that was driven by their great business models that were asset light. They were not in, capital intensive industries, and as a result, they produced really impressive returns on invested capital. And so, for example, if you look at the Mag 7 right now, back 10 years ago, if you take a look at CapEx, overall capital expenditures as a percentage of revenue for all those companies in aggregate, 10 years ago, it was about approaching 7% of their revenue they'd spend on capital expenditures. Today, now, we're crossing over 15%. And there are some companies like Meta that are eclipsing 35% of their revenue that they're allocating or committing to spending. And that is far in excess of, if you go back and look at these historical investment or capital investment booms, like technological innovations that were society changing, like the railroad boom of the
late
1800s and on into the of course correlating with the Industrial Revolution, and then of course the internet bubble or also / telecom boom. The percentages of the revenue that was contributed to CapEx was very high then among those railroad companies, among those telecom companies, and obviously those companies historically did not produce substantial cash flow or returns on their investment capital, or also did not have good stock price performance subsequent to that.
I think
and now
part of the built-in challenge there too is the more money that they start to spend, the more it needs to be somebody else's money, right? They don't have the cash to spend.
Yeah.
They're having to go out and start to borrow it now to do what they would have done in the past with their own money.
Right. So for example, I think we're up to now, if you look at the kind of aggregate of all the big tech firms, the plans that they have made or that they've announced or the commitments they've made in terms of AI investment is now eclipsing $5 trillion over the next 5 years in aggregate, right?
Yeah, it's enormous.
And so, what kind of revenue and profitability and cash flow do you need to justify that kind of investment? And is it even remotely possible to generate a decent return on investment on $5 trillion?
Yeah. So this is a good example of another market pundit, Richard Bernstein. He worked, I guess, for Merrill for years, and now he's got his own family of funds. But he had a handful of hallmarks for a bubble that he would always call out. The idea that they start with increased liquidity. There's just a ton of cash in the system. Mm-hmm. Cash has got to go somewhere. People start spending it. Companies start spending it. Then you get to the point where there's increased leverage. Mm-hmm. So you have these large companies that are, taking on these gigantic projects, and they start borrowing money. And then, ultimately they get to a point where there's some kind of squeeze, liquidity dries up, and things go bad. But You're at that point right now to where you've had so much cash in the system for so long, from, whether it was, COVID money in the system, the Fed's actions, whatever it might be. And you've gotten to this point now to where they've got great business models with things they want to invest in. They're spending tons and tons of money. They're going to take out tons and tons of debt. And it never ends well when, companies start going down that path. So,
well, and to that end, the proliferation of private equity, which has been made available to more retail investors, mm-hmm. right, under the guise of democratization, right, where that was something that historically was only available for the largest investors, that they found a way to shrink it down to where with a smaller amount of money that you could get in on these types of deals. And the issue is that these private equity companies that they bring in this cash from investors, they're obligated to go put it to work. And so they're not concerned about what the valuations are in these particular areas. They have to go and deploy that capital, and they are partly to blame for where the valuations go in a lot of these areas. But I want us to go back and talk about the amount of debt mm-hmm. that these companies are having to take on. So I did a little teaser for the podcast today, and two of the areas that I talked about that I think are very close to the epicenter of this market risk in the is there an AI bubble question is looking at Oracle and OpenAI. And so OpenAI, as we've already said, is the company behind ChatGPT, which I am sure that these large language models and these generative AI types of platforms, that they will revolutionize the way that we use technology Absolutely. Going forward in the same way that that the internet did. Mm-hmm. But I think you said early on here that the companies that brought us the internet, a number of them don't even live anymore, mm-hmm. right? They're not. But society has benefited exponentially from the technology. Is AI going to be a similar type of deal? But you have OpenAI that they just passed like a year in business as a private company, mm-hmm. so they're still private. They did $10 billion in revenue in their first year, which is extraordinary.
Sure, it is.
The problem is that they have $1 trillion plus worth of commitments that they have made related to the build out of what they want their company to look like. Part of that was a deal that they announced back in September with Oracle, where they were going to contract with Oracle $300 billion, $60 billion a year for 5 years for cloud computing services. That were supposed to go online in 2027. Well, early November, if we can, throw the quote from the Bloomberg article in there that came out. So Sarah Fryer, the CFO of OpenAI, comes out and essentially says that in order for this AI capex to be able to, be carried out the way that they all intend for it to happen, they recognize they're almost going to need government backing.
Mm-hmm.
And
almost, they're definitely going to need.
They're going to need government backing,
and they're trying to bully the U.S. government into participating in this by saying it's a national security issue if we don't beat China.
Yeah,
Right.
And so you have Jensen Huang saying almost at the same time that he thinks that China's going to win the AI arms race, which is just trying to bully Congress into saying you can't let this happen. If so, you're going to need to pony up. But so you have these companies that are now massively leveraged. Okay, so if you look at Oracle's credit default swaps,
Yep.
which is the protection that investors in their bonds would use to insulate themselves against a default by Oracle, their inability to pay, that those things have just gone vertical in the last several weeks or a month. And so the market is starting to be very skeptical about whether or not a lot of this build out is either going to take place, if it is economically viable.
Right.
And so the concern that I have is that if some of these companies have to start to renege, what if either the market shuts them out because they can't afford the financing anymore, maybe the interest rates are too high, or they just will not lend them the money absent government backing, or they just recognize that there isn't sufficient demand for it, which I don't think that they're going to come to that conclusion, but kind of along the similar lines as where you had the railroad boom bust in the late 1800s, the telecom stuff in the late 90s. The railroad companies in the 1880s, they were just laying track everywhere.
Mm-hmm.
And they were
something thousand miles within like 5 years.
They were way overbuilding these railroads, and people actually started to look and say, I don't think we need all of these railroads like running in all these different directions.
Yeah.
We could consolidate, and we would still be fine. And it turned into a massive financial crisis because they were way over leveraged, they had way overbuilt. So I don't suspect that these AI companies today are going to come to the realization of, we're not going to have a sufficient amount of demand to meet this and we should scale back.
Right.
They're going to push capacity, and then we're going to find out that there isn't the need for all of those different rail lines.
To your point before, that's the definition of malinvestment, right?
That is malinvestment. But now, to the point that you were making earlier, it isn't just their money now that is at stake. It's money that they have borrowed.
And that's an important point, that whenever you have something like this, a bubble, overvalued market, the cracks always appear first on the credit side, right?
Yep.
It's the bondholders and the people who are extending that credit to these companies to be able to build the things they want to build that are the first ones who get spooked. And so that's why you start to see, the Oracle CDS blowing out like it did. That's scary stuff.
Yeah, it's a precursor of what could be. And so one thing about going back to the definition of a bubble, right? So there's a core demand, of course, that's there, and in this case, it's dramatic. It's society changing, right? With technology evolution and innovation has taken us to this point. The prospect of massive productivity enhancement, accomplishing. I just was watching someone else's podcast yesterday and talking about this concept of, a lawyer doing legal work, can accomplish. I mean, is AI going to replace a lawyer? Probably not. But is it going to help a lawyer do, either do it for much cheaper or do 10 times as much work in the same amount of time? Probably the latter, right? So that's great. So there's a lot of massive productivity enhancement that comes along with this. And and so the demand is there at a core level for the technology.
And just to add, it always starts in a good place, right? It makes sense for people to invest in that. It makes sense for those stocks to be going where they are. The goofy stuff doesn't come in until later on.
Correct, yeah. And so, but when you start to get to this level where we have now, talking about the massive, kind of the chase almost. As a matter of fact, I don't remember the quote, but it was one of the big tech execs that basically said, it was essentially a matter of having to be in this race, having to win this race no matter what, even if it cost bankruptcy. And so, you get caught up in that euphoria, even at the executive level of these companies. We got to do these massive investments to win this race. Well, when you get to the level of sustaining that from a capital investment standpoint by way of malinvestment and by way of bringing on massive amounts of credit, and because of, like you said, it starts with excess capital being available. Mm-hmm. Then you get to the point of demand gets pushed beyond what is natural. So we saw that in housing, right? In the housing, underpinning the housing bubble was all this crazy stuff that was going on under the surface that led to the massive availability of credit that led to people being able to get capital for houses, let's say they couldn't afford or way beyond what they otherwise could afford. And so it led to massive overinvestment until finally the music stopped. There was a crack in the dike and in the dam, and then all of a sudden it just led to the draw or the drawdown happened when the first evidence was there, and then all of a sudden it's just kind of a race for the exits. And so that's the risk that
there's no price too high, right?
Correct.
Well, and that was the how did you go broke, right? It was gradually and then suddenly, right? Type thing. And that, but if you go back to the housing crisis, that there was a push from a policy perspective of we wanted more home ownership in this country. We were in a place from a monetary policy perspective where rates were lower, and so you had lower interest rates, but you had lax lending standards that they had the no income, no job loans. There was no verification.
Zero doc loans.
Yeah, no doc loans. That there was capital that had to get deployed by private funds. That the initial perspective is that home ownership is good. We're going to invest in people to invest in the mortgage side. People are going to be able to buy homes, which is good for society. So that's the positive lens on it. It turned into there's money that's going to have to get put in there. There isn't enough demand for these loans for regular borrowers, so we've got to drop the standards so we can give the money to anybody. If you can fog a mirror, you're getting a loan. There was plenty of fraud going on, and we are seeing similar types of things in 2025 in the private credit space. And the cracks emerged 2-3 months ago where you had First Brands, who was a auto part manufacturer, that they ended up filing for bankruptcy. They had corporate fraud. They were big time tappers of the private credit markets. So they went under. There have been a number of kind of, let's call them lower profile bankruptcies that have been the first signs of, there were lax lending standards in this space. And here's the reason why. Post the financial crisis and Dodd-Frank, so a lot of this lending, more mezzanine financing, it used to happen in the banks. But Dodd-Frank forced it out. They can't do it anymore. So the market just repackaged it. Now it's in private credit. And these private credit deals, they've been pushed by some of the very large investment banks, wealth management firms for the last several years as places where you could go and earn higher rates of return, interest. They're supposed to be more secure. They're not going to have as much interest rate risk, which post-2022, a lot of people were very interested in. They're supposed to be securitized, but they are illiquid, and we're finding out that the lending standards there are next to nothing because they've got hundreds of billions of dollars that they have to deploy. They cannot be scrupulous, and they can't be overly discerning about what we put the money into. They just know that they have to get it put to work.
We also don't know how bad it is because of the mark-to-market rules. And
that's the other part of it. So here's in the teaser that I did for this, where I talked about Oracle being one of the companies that I think is, has maybe flown too close to the sun. The other one is Blue Owl, and now Blue Owl is a private credit company.
Yeah, they've grown to become one of the largest private credit firms in the country.
Right? So now they're right up there with Blackstone, KKR. I know BlackRock has some private credit funds, but Blue Owl, that is what they do specifically. They're not diversified necessarily, in their business lines like some of these other companies are. And their stock, I think, because there are no marks, there is no marking to market of these private deals. The way that the covenants are written, they don't have to, right? It's very new age. The way that they've done this, it never could have happened in a bank, right? The bank never would have been able to do that, but they I'm sure get companies like E&Y to come in, and they're supposed to do an audit routinely to try to assess whatever the net asset value is of these funds. But as our friend Larry McDonald always says, he always talks about bleeding out the truth. And that the marks that they may be showing on some of these deals, maybe they're souring a little bit, like very slowly. But I think that Blue Owl's stock may be a better read on what's actually happening within these funds. But here's the deal. You've got people that have bought into these things with a presumption that these are safer assets to invest in. They're going into this space that's garnering a lot of attention, like the data centers. So Blue Owl was just one of the primary underwriters of the Meta deal, or the Meta data center. The $27 billion is being built in Louisiana. That's almost the size of Manhattan.
It's going to be it's a joint venture they're doing. The two companies are doing. So real quick on that, it's as a result, Meta's been able to do some accounting trickery, and that's not on its balance. It's an off-balance sheet commitment that they've made.
Yeah. So Blue Owl, in effect, they're getting to use Meta's name to kind of market the deal. But if it goes south, Meta is not responsible for repaying any of the money.
Pretty much. There's recourse to some extent.
But it's small.
Right.
It's small. They're not borrowing the money from Meta.
Right.
Or Meta's not borrowing the money from them.
Correct.
Right.
And this is akin to the mortgage bonds in 2008, and the ratings agencies taking their time and actually rating them appropriately.
Yep.
So
but again, the only difference is then those mortgage-backed securities, they would trade.
Yeah.
Right. They would trade. They traded on the exchange. These things don't trade, and so you have to rely on what they're telling you. And my concern is that people have gone into these things with rose-colored glasses, and this is going to be what separates this from just being an area of the market that's overvalued and has to correct, and what turns this into a bubble, this is the malinvestment. This is where the bondholders have the potential to face material losses.
Yeah, and this is something that's gotten to be so ubiquitous recently, right? The number of people that are going into these private credit deals, the fact that they've started to, for lack of a better term, democratize a lot of that type of investment. You've got a lot of people that are tied up in those types of funds.
Yeah,
so,
absolutely.
Widespread impact.
So real quick on that, parallel with the real estate market, one of the underpinnings of that was you had institutional money, traditionally conservative institutional money, specifically pension funds, that because of the rule changes that were going on and the way they were doing some of the mortgage-backed securities, and even some of the special purpose vehicles, but the way they were dividing these up in tranches, and they were able to get the ratings to be higher than they otherwise should have been, that justified pension plans being able to put money into these vehicles, invest in these markets, because they were quote high quality, right? They were investment grade, supposedly, and of course they really ended up not being. And so, but that resulted because of that the infrastructure that was built, it allowed for massive amounts of capital to come into a space, underwrite and finance these structures. That was the source of capital, fueling the overinvestment in real estate. And that's similar to what's going on now. So Blue Owl, they've been around for a while, but their fastest growing focus within private credit is data center and underwriting loans to data centers. And so
that's where the demand is.
Correct.
Right?
Fair.
And so now, again, back to this point we made earlier, is all of this in aggregate is resulting in, and we haven't even talked about this. Let's maybe transition this circular kind of weird thing that's going on investment wise, where these companies are all investing in each other, right?
Yeah.
And it's like, so for example, OpenAI doing a deal with NVIDIA and vice versa, and so it results in this, kind of ongoing virtuous cycle of, hey, I'm gonna borrow some money over here to invest with you guys, but then you're gonna try and invest back in me and buy my chips to sustain the data centers being built, and so you build this malinvestment, overinvestment ecosystem where everybody's invested in each other and dependent upon each other.
Yeah.
And so
you get a crack in one, and then all of a sudden
there
you
you
get a
go.
problem everywhere,
Exactly.
right?
That's ultimately where this is going to go.
Yeah.
And when that music stops, we don't know, but we know that the table is being set for it. The ice is getting thinner, and so it's very important for us, as it relates to how we manage money for our clients, to be aware of it, understand it, and then to now position properly so we're not overly exposed to the risk of that collapsing when it comes.
Yep.
But then also looking for the areas that are going to endure or benefit from the rotations that will come when that happens.
And so I would say that the main things that investors need to be concerned about right now is how much exposure do they have to these things. And because our industry is so heavily passive, and people, if they just own the S&P 500 index, they unwittingly don't appreciate how exposed they are to these things.
So not even just the S&P. I mean, sorry to cut you off, Jeff, but
that's right.
How much have we seen recently where you've got S&P large cap value funds that own these massive growth names, or you've got international funds that are holding Meta and NVIDIA, and they've gotten so far out of their style box that there are clients of financial advisors out there that have no idea what they hold, and they don't realize that they're holding these same positions in other areas of their portfolio where they think they're diversified.
Yeah, absolutely. So to the point here, this is some data from since ChatGPT's release So that's what, 1 year?
Yeah.
Since that time frame, AI stocks have accounted for 75% of the S&P 500's return, 80% of the S&P's earnings growth, 90% of capital spending growth within the S&P.
Yeah, and I'd say it's even beyond the stock market. If you look at GDP numbers, not including AI investment, they're flat or down for the past.
And that's going to be the concern. That is going to be the concern. We have not seen it yet. Now, we talked about it some in one of our monthly reviews, that if you look at the areas of the market that are attached to the marginal consumer, the restaurant chains, retailers, some of these things have been smoked.
Yep.
And so there is a huge bifurcation right now. I think probably 100% or more of the economic growth that we've seen so far in 2025 has been attributed to AI CapEx. And where the Q3 numbers still seem like they're going to be somewhat robust, maybe annualized at a 4 to 4.5% rate, Q4 is probably going to see much less. And so Q4 is probably going to be one of the first pieces of data that we get that would show us what does this economy look like ex AI spend. And if the well is starting to dry up around the AI investment because they already recognize there is malinvestment there. And so to chase dollars into it is not a good idea. That's when you start talking about things like recession in a big way.
So maybe that's, I mean, we're dancing all around the idea, but, a question I imagine everyone has is what causes the pop, right? And, like, obviously could be a million things. Nobody knows now. You can always tell in hindsight, but,
I'll tell you what my guess is. My guess is what actually causes the pop is that somebody, one of these big AI players, has to renege.
Yep, that's what I was going to say.
And that is soon the first person that backs out that says, it's not that I'm not doing any deals, it's that I'm not doing this deal. That all the that it becomes a house of cards at that point.
Yeah.
And you look at OpenAI, and I see people post on social media about OpenAI and how they want to relate it to, is it a Bear Stearns? Is it an Enron type situation?
Yeah.
I have no idea, but what we do know is that company is unbelievably leveraged for a company that is 1 year old.
And so also, you got the fact that one of the ideas that's been floating out there is, okay, well, they've committed over $1 trillion to CapEx. Where's the money going to come from? They make $10 billion. They do $10 billion in revenue now. Now that's, like you said earlier, that's a quick ramp early on in its life cycle as a company, but maybe it does parabolically rise from here, and they do 20, 30, 50, $100 billion in revenue. But most likely, that's not the case, especially because all of this is incredibly competitive. And that's the issue as well we got to think about is all this investment that we're talking about, this capital investment, hundreds of billions of dollars, trillions of dollars in data centers and all the related ecosystem and infrastructure is into capital or infrastructure that at its very nature is quickly depreciating because it's technology that is advancing at a parabolic rate
so the obsolescence behind it.
Yeah.
Right.
So you build a data center and you got to go in there when the thing's finally done, just down the road from us. We got this big massive one going in, and it's a multi-year thing. And you got to think once the thing's finally done, the racks, the actual computers themselves and the chips that drive them and all of that.
They're going to be worth a fraction
by
the time they're able to get deployed.
Right. Well, they have to do a whole, upgrade cycle.
A refresh.
And what does that look like? So So I think that a couple things. One, there's that aspect of this capital expenditure cycle that we got to recognize is a risk, massive risk for the people that are taking on the debt to do the investment. It's like, it's almost akin to, some debt's good, some debt's bad. Taking on debt to buy, valuable appreciating assets that are productive is fine, but taking on debt to buy depreciating assets is not so smart. And in some ways, that's what's going on.
So let me say this. Here's the other piece about OpenAI that, and whether or not that one turns out to be what pops it, and if it's whether they renege off of a deal. I wonder if some of it is going to be that the market simply calls bullshit on some of this. So they just there were numbers that came out about the amount of energy that they're going to need for all these projects that they have on, right? Let's put that up.
Yeah,
but
the OpenAI 125x energy capacity in the U.S. in 8 years.
Yeah, that within, I think it's within 8 years that company by itself would use the same amount of power in a given year as India. and people are going to accept that we actually think that that's going to happen.
Well, and that, to your point, the pop itself could just be. These are supply and demand markets when we talk about the financial markets, and it's at the end of the day, if there's more sellers than buyers, then guess what? Stuff's going down.
Yeah, and
so it could be that, and if you look at the history of any bubble, right, it always starts with, like I said before, too much cash in the system, right? There's too much liquidity. All of this investment happens. It gets out of control, and then somebody goes, "I want my money back."
Yep.
And then somebody else says, "I want my money back."
Yep.
And then everybody wants their money back.
And then it's the reverse chase. Like right now we're in the mode, or we have been up to recently, the mode of it's
where can I put my money?
It's FOMO, right?
Right.
Fear of missing out.
Exactly.
I got to put money in. My neighbor's making money. My neighbors, my brother-in-law, everybody is putting money in this and making money, and so I got to get in on this. And then when the reverse happens, it's it's a double-edged sword, right? It's oh my gosh, you got out and you heard this and this is going on, then I got to do the same.
But by the time they get there in their mind that they want to sell, things will have changed, right? There will be something that has happened to where the price isn't going to be at the same place it is now.
So envision this, back to OpenAI and this whole issue of where are they going to get the money for the $1.4 trillion they've committed or whatever. What I was going to say earlier was part of the idea was that it was going to come from them going public and raising capital, and the numbers that were floating around were is going to be the first $1 trillion IPO. Well, if all of a sudden the metrics have shifted, the CN has shifted, and they finally decide to go public because we need to raise capital, and then what if, to your point earlier, the market calls what, and then they go out to the market and the valuations that are kind of floating around are way less than what everybody expected.
Yeah.
And now they're like, either we can't do an IPO or let's go ahead and do it, and we raise substantially less than we thought. And that's when that if that did occur, that would be a moment where it'd be a freak out moment for the market.
So where I think this leads us naturally is, you're an investor right now. What do you do? And, I'm going to pull out an example. I might be front running. This is a 1929 example. Charles Merrill started Merrill Lynch. 1928, January-ish, he couldn't take it anymore. He said, this market's crazy. Don't want to be invested. He was telling his clients to sit on the sideline. History proceeds. September of 29 was the start of the crash. And between January of 28 and September of 29, the market went up 90%. Mm-hmm. And so, the answer is not go hide under a rock. I think one of my favorite quotes, George Soros always talks about running towards a bubble.
Right. That's when you can make the most money.
Tons of money to be made there, but you have to have some knowledge of when to call it quits. And so, the question for any investor right now is, what do you do?
Yeah. Well, it also goes back to Kenny Rogers, right? You got to know when to hold them, and when to fold them, know when to walk away, and know when to run. Right. But so I would say that investors need to be very discerning about what they own, and I think that they should do everything they can to minimize the exposure that they may have to this space. Now, that doesn't mean it can't get more expensive, but when we see some of these markers, like CDS blowing out for Oracle, when you see the CFO of OpenAI effectively requesting a government bailout for that, those things don't happen if everything is hunky-dory, right? So on the equity side, you may be able to go in and say, I need to try to dial my risk down a little bit. Now, in some cases, some of these stocks, I'll use Oracle as an example, because it had traded all the way up to $345 a share, and it is at $194 right now. So it's already down a lot.
Right.
Now, it could go down. The last time its CDS were as blown out as they are today, the stock was at 65. Okay? So there's still plenty of downside that could happen. My concern, and this is where I say if it's a bubble, it's going to be the bondholders that get hurt. My concern is going to be for the people who are in these private credit deals, Blue Owl, Blackstone, BlackRock, and there may not be anything these people can do, because these are alternative investments. They are going to get gated.
Yeah, that's right. They'll get gated. The first step will be, well, this is going to take more time to play out, so we're gonna put redemption stipulations on. Already, you can't get out very often anyway. Maybe if they're interval funds, they allow for quarterly redemptions up to a certain limit. But most of these private credit funds are not even structured that way. They're longer term, and so when they already tell people that go into them, look, this is longer term, 5 to 7 year time frame, right? But they do hold out the hope that there will be some liquidity options or opportunities. But all of a sudden, if they get into this situation we're talking about, that'll be what'll happen. They'll gate them. They'll say, like we've seen before with BlackRock, when they had that happen with BREIT.
Yep.
It will always fix itself with more time, though, right?
Right. It doesn't always fix itself. It just gives the firm sponsor more time to try to figure out some kind of creative way to deal with it. But in the meantime, people's capital is locked up, and you potentially see diminishment of any kind of dividend or distribution schedule or structure go away, and then valuations begin to contract, and you don't know what the valuation is.
And they're ultimately, there could be some outright losses that happen there. I mean, that happened with some of those mortgage-backed funds that Bear Stearns and others had back in early 2007, right? That they had melted down, and that was just starting to make the headlines in early 2007. That was 15, 18 months before the stock market took a dive in late 2008. So my concern is that those folks are going to feel the brunt of some of this. And if they're already in it, there may not be anything that they can do, because those funds are already starting to limit redemptions, or they may outright gate them. But here's the other side. Okay, the other side of this conversation of, are we in the largest bubble for U.S. stocks that we have ever seen? In some cases, I say, yeah, we are. You look at the valuations in some of these technology stocks, the AI names in particular, the malinvestment that's happening there, the amount or the percentage of the U.S. indices that these large names comprise. We say that 73% of the MSCI global
stock market, yeah,
is comprised of U.S. market capitalization, all-time high. So, yeah, there are things there that say this is a bubble. The other side of that equation is there are areas, even within our own market, that haven't made any money in a lot of years. So the entire energy sector, it is worth the same thing today that it was in May of 2007.
Yeah.
I mean, we're talking about 18 years worth of no progress. You've got a lot of these international markets that have just recently broken out of 15, 18-year bases where they haven't made any money in a really long time.
Yep.
I think it's hard to suggest that those things are in a bubble, right? So there are elements of this market that are certainly not in a bubble.
Yep.
The problem is, do you know what's in a massive bear market?
Asset allocation.
Investor diversification. And so people are going to be hurt when this thing does unwind because they are most exposed to the things that are the most expensive. And if they would focus on diversifying,
truly
diversifying. And what does that mean? It means buying some things that haven't done that great.
Knowing what you hold, right?
And maybe why you hold it. But so there are things out there that are decidedly not in a bubble. The problem is you don't own it.
Within the realm of what has not done as well or what is not in a bubble, exist many companies in many industries that are actually going to benefit greatly from this AI boom. And they're not having to make these trillions of dollars of investment into it. They just get to...
They're the benefactors.
They get to tap into it and benefit from it, right?
Yeah.
And what's interesting, again, historically, that's what you see. So, after the railroad boom occurred, the economy did phenomenal, and the productivity of our economy, the output of our economy grew dramatically because of that innovation. And so many companies were able to tap into the benefits of the railroad. Same was true for the internet bubble, and the telecom build out and the internet build out itself. So, like you said earlier at the very outset, some of the companies that were building the infrastructure of the internet don't even exist today. But so many people, all of us today, are benefiting dramatically from the internet. And so that's going to be the case as well. This whole AI thing gets built out and all this money gets spent. And then all of a sudden there are multiple companies that are these, there are some that were early adopters of AI, but even now there's still many that are just now adopting AI. And those types of companies that are going to benefit from it, utilize it, and leverage it to be more productive, to be more profitable, to be more efficient, and yet do other things in different industries there are many of those that are attractive out there.
The one thing that I will say about that's kind of the negative side of it is that there are going to be a lot of people that are economically displaced.
Yes.
Because of the implementation of AI. There are going to be, God knows how many millions of jobs that get lost.
Unfortunately, that's true.
To AI. And just some of the things that I've read here recently is that, there are plenty of entry-level jobs that are going to be done away with because AI is going to replace those things. The unemployment rate, I think currently for those, for new graduates with a bachelor's degree is over 10%. And so the marketplace, what they have a strong desire for is for a productive employee who understands the basis of what they're doing and can use the technology
Yeah.
to make themselves even more productive, they don't need somebody who just knows how to use the system, right? So they don't need somebody who was maybe learned how to use the technology in school but doesn't understand the way that things have happened for many years to understand, like, what am I actually asking the machine and the system to do?
Right.
So that is where, and you kind of go back to Industrial Revolution, that is where, from an economics perspective, where the transition can be quite bumpy.
Right. Oh, yeah, for sure.
And so that, I think, is a potential downside that I'm sure there were some people who got displaced by the internet, right? There are not as many couriers today as there were back then, but maybe it was easier to retrain people with jobs then than it is now. But there are a lot of jobs that are going to be taken by AI. They're going to be replaced by AI. But I will say, in our business and in our industry, at least for the clients that we're working with and serving, what they value the most and what they tell us is that they value being able to speak to a human being. That it is lost that if you're calling customer service or whatever it is, you're talking to some sort of AI
or a bot
somewhere.
I'm the guy that just says representative the whole time.
Yeah, and same here. It's infuriating. It's like, I want to get somebody on the phone. I want to tell you what I'm trying to do, and you tell me what I need to do to figure it out. And it's hard to find that anymore. But I do think that that's where you're going to have some maybe more durable economic murkiness, is the transition from an employment standpoint. And we're starting to see it. Unemployment rates starting to creep up a little bit, and more so in the new grads, the recent grads. So let's close our discussion here today with this idea that we have all had a consensus around the idea that we've got bubble tendencies going on right now. Investors need to be very diligent about reviewing what they own. I would say they need to make sure that they have a process by which they can understand, at some point, I've got to change the way that I'm positioned.
Yeah.
Because you're going to have to protect yourself.
Yep.
Anytime when in these last three bubbles that we talked about kind of earlier, internet, housing, energy, when the tide turned, every single one of those sectors went down 80% plus.
That's right. And they all comprised at that time, like they do today, the biggest percentage of the stock market.
Yeah.
Because of the market capitalization nature of the indexes.
And so you've got to find a way to be able to pivot. You need to be adaptable to what you're doing. You got to protect yourself. Don't just stick your head in the sand and say that this time is different, because we've all heard that before. It may look different, but the path for these things always tends to be somewhat similar. But do what you can to protect yourself. Be adaptable. Be diversified. For crying out loud, please be diversified. And we are going to come back for a follow-on episode. As I said, we're going to be reviewing 1929. If you have not picked up a copy of this yet, I certainly recommend that you do. Andrew Ross Sorkin, great author. If you haven't read Too Big to Fail, which was his work about the housing market and the housing crisis, certainly a great read. I would encourage you to pick that up. But we're going to be reviewing this in our next episode, and we're going to be talking about what led to one of the greatest crashes in U.S. history, and if we find any parallels today to what was going on then. So, boys, any final words before we wrap it up?
Be alert, but yet don't be fearful. And I think that's one thing that I will leave us with is, on the horizon, we can see that a storm is brewing. We're definitely not, even though we've been talking about understanding the context of the markets, we don't try to predict these big cycle turns. We want to be aware that they're likely. But that's why, obviously, we all love our discipline, because it helps us to Wait for confirmation of these big trends that are changing, and then adapt accordingly.
Yeah, be dispassionate about it, right? And then to your point, yeah, we don't have to. This isn't meant to be a fear-mongering discussion, but it's meant to assess honestly the landscape that we're in right now, but also to recognize where a lot of people are going to be very badly hurt when this happens, but it can also create one of the greatest opportunities for people who have positioned themselves appropriately going in. Michael, anything?
No, I was going to say, you're coming out of this because we know that at some point this is going to turn. Coming out of it's a huge opportunity, but it's only an opportunity if you didn't have yourself fully invested going in.
Yeah.
And so you've got to know what you hold. You've got to know how diversified you are. You've got to know when to be adaptable, when to take chips off the table. So having a process is never more important than times like these.
All right. Thanks again, everybody, for joining us here on this episode of Bugle Notes. Please make sure that you are subscribed to all of our social media channels so you're getting the latest of our thoughts that we're sharing with you on a regular basis. Please be sure to join us here for our next episode, and we will see you next time.